Good morning, everybody. Thank you for joining our first webinar, Putting Your Financial Pieces Together. Capital CFO is actually hosting two webinars in May. Today is our first, Financial Statements to Prepare You for Today and to Plan for Tomorrow. Next Tuesday at 10:30 in the morning, also via Zoom, we're going to be hosting a nonprofit webinar on how nonprofits can survive during this crazy time that we're living in right now. So thank you again for joining us. My name is Sabrina Hauser. I am the owner of Capital CFO. I'm sorry, my computer is not switching to the next slide. There we go. I am the owner of Capital CFO. Our mission at Capital CFO is to work in your business so that you can work on your business. I started this company about 3 years ago because I was the CEO and the CFO for a local nonprofit. And I realized that there are probably a lot of other nonprofits and businesses that were operating in the same way, where either the leader of the nonprofit or the business owner was wearing all sorts of hats. So I really wanted to start a company in order to help people get the experts that they need, but not necessarily full-time in-house. Sometimes when people think that they only need a few hours a week of something, they tend to just take that on themselves. And Capital CFO allows you to remove that from your plate and give it to experts who can do it much more efficiently. So we're able to work either on-site or remotely for our clients. And today we're going to be talking about some financial statements that Capital CFO can certainly have been helping their clients with, and hopefully will help you along the way too. A few housekeeping things to go over. If you are calling in by phone and you are not on the video with us today, please email any of your questions to Katie. It's katie@capitalcfollc.com. Even if we can't get to your questions today, we'll be sure to follow up with you via email. And even if you are on the video and you prefer to do that, you can certainly shoot us an email that way. If you're having any technical difficulties, just reach out to Katie via the chat box. And this session is being recorded, and we'll be sure to make the recording available. So if there's anybody on your team that wasn't able to join us today, you can certainly share that with them as well. If you do have questions along the way or comments, please put them in the chat box at any time during the presentation. If we can't get to your specific questions, we'll be sure to follow up with you after the call. If you have any questions that pertain specifically to you or your company, something that you don't want participants to be aware of, please feel free to reach out to us and we'll be sure to follow back up with you. The three financial documents that we're going to be discussing today for your business or your nonprofit are your profit and loss statement, cash flow projections, and end of the year projections. So first, we're going to start with a profit and loss statement. We're going to talk about what a profit and loss statement is, how do you read one, and then how do companies and nonprofits use profit and loss statements. So first, let's talk about what a profit and loss statement is. A profit and loss statement is also referred to as an income statement, a P&L, or a profit statement. It indicates how revenue, not cash, and I'm going to be bringing up that point a lot during this webinar, so it's vital that we keep that in mind. It indicates how revenue, not cash, is transformed into the net income or profit for your company or nonprofit. It's a result after all the revenue and expenses have been accounted for. It's set for a very specific period of time. That period of time could be a month, a quarter, 6 months, or a year, but versus a balance sheet, which is a single moment in time. It shows your revenue and expenses for that time period, not your cash in and cash out. So for example, if you are a company that invoiced for a service or a product, that invoice will hit your P&L the month that you generate the invoice, regardless of if that client paid for that service or product. So whether or not you have received the cash, your P&L statement will show up the invoice that you generated. So it's different than a cash flow. And it summarizes your revenue, your costs, and your expenses incurred during a very specified time period. And this is usually a fiscal quarter or a year. So how to read a P&L. It always starts with a summary of your revenue and the income that you generated for that time period. It then details all of your costs and expenses. And finally, it calculates your net income or your bottom line for that time period. So how do companies and nonprofits use a P&L? It helps you to calculate if your company or nonprofit is in the red or the black for a time period. It helps you to see if you're staying ahead of, on track with, or behind your yearly budget. And the purpose is to show owners, managers, and possible investors whether your company made money and therefore is in the black and making a profit, or lost money and therefore is in the red during the period being reported. So let's take a look at a very simple P&L for a dummy company that was created. So you'll see at the very top of the P&L is just the company name, the profit and loss, and then the specified period of time. So for this specific example, it's January through April. It always starts with income. So this is all the income that that company generated. Again, not cash in, but this is all the income and revenue that they generated for January through April of 2020. Here's their total income. So it's just an addition, and their gross profit is right in there. Then it details out all of their expenses for that time period. So this company's gross profit, January through April, was $35,350. Their total expenses for that time period is $14,250. So their net operating income is the $21,100. Again, not cash in, not cash out. This is invoices that were generated during that time, regardless of if a client paid for that product or service. And these are expenses that are generated out for that time, regardless of whether or not you actually put the cash out. So some of these expenses are on a credit card that you won't be paying for until next month. It is still hitting your P&L statement for an accrued P&L. I am going to go over a much more detailed P&L statement on the next slide. And then right after that slide, I'll pause and see if we have any questions. So this one's a little bit more of a detailed P&L statement. Same time period, January through April, but the difference with this one is that it looks at just the month of April, just what the month of April budget was, what January through April generated, what year to date the budget for January through April should have been, and then the annual budget for this specific company. So most companies, when they do have a budget, what they'll do is they will generate their P&L statement by taking their expenses and income that they are hoping to achieve and breaking that out by 12. So just the 12 months laid right across the board. There are companies that have really good historical data that they're able to use where they're actually able to put peaks in and say, I know that I make a lot more money in January through March. Maybe my summer's a little bit slower. So they're able to kind of put that into their P&L instead of just saying, I'm going to make the same money every single month. So it really just depends on how much historical data you personally have for your company. So let's go through this together a little bit. So for the month of April, this company's total income was $25,000. Their calculated expenses for, again, just April was the $5,750. So in April, this company made a little over $19,000. Their budget, again, for just April was $20,000. So simple math, they were just $5,000 over their anticipated budget. Their budget for total expenses was $5,000, so they were a little bit over their budgeted expenses for April, but still their net income was much higher than they had anticipated. And then January through April, this company has generated $65,000 January through April. That was also their year-to-date budget, so they're right on track. Their total expenses January through April was this $19,500, but their year-to-date budget was the $22,200. So their net profit is a little bit higher than what they had anticipated year to date, just because their expenses were a little bit lower. I'm going to hit pause right here and see if we have any questions that I can answer before we move on to the next slide, Katie.
We do. One of the questions we have is, are you going to discuss accrual versus cash method?
Yeah, yep. So one thing that we talk about a lot is the income versus and revenue versus cash in and cash out. So cash statements are something that we'll be going over in the next few slides, but a lot of companies use the accrual method of calculating their accounting because it's a little bit more accurate. If you are a cash only company, you can still do profit and losses, you can do cash flow projections, but most companies are on an accrual basis because they are invoicing but not receiving that cash. So it is how a lot of financial statements are generated. Anything else before we move on?
That's all we have so far.
Okay. So in our next slide, we're going to be talking a little bit about cash flow statements and cash flow projections. So what is a projection? How do you create projections? And how do you use projections for your business and your profit and loss? So let's talk a little bit about a cash flow statement versus a cash flow projection. The purpose of a cash flow statement is to show a company where their cash is being generated and spent. A statement shows transactions that have already taken place, whereas a projection shows future predictions. Cash flow projections become crucial to help you navigate during challenging times, and they also help you to determine how many days on cash you have on hand before things take a turn for your company or nonprofit. Forecasting your cash flow also becomes really critical and vital for financing because cash is the lifeblood of your business. So how do people read and create cash flow projections? First, you find your cash for the beginning of that period. You then estimate incoming cash and incoming expenses that you have that you're paying out. And finally, you calculate the cash at the end of that period. Now, you're going to be hearing me say things like projections and estimates a lot in the next two financial statements that we're going to be talking about, which can feel and seem like a guess, but they're really not. These are very strategic plans based on either data in history or budgets that you have set in place. So one thing that we are assuming at the beginning of this webinar is that everybody has started at a place where they have a budget. A budget is vital in order to create these financial documents because it helps you set your goals throughout the year. And again, if you have some data in history, you can kind of create a budget based on that data and history and maybe uptake it a little bit and kind of figure out what your months are that you are doing really well and some of your slower months so that you can help yourself plan instead of constantly react. So how to use cash flow projections. They help you to predict shortages and surpluses, which can help you with your planning. It helps you to estimate the effects of a change to your business, or if you absolutely need to be making a change to your business or nonprofit. And it also helps you to prove to lenders when you can pay them back. So let's talk through cash flow projections and statements a little bit together. So I'm going to start here. So this is, you will see on this line, January, February, and March are actuals. Those are dates that have already been passed for this company, and they have their actual figures in there. Whereas April through December of that year are all now going to be estimates. This line shows the beginning of month cash. So this company started January with $15,000. The cash that they brought in, not the revenue. So this also includes invoices that might have been invoiced in December and were paid for in January. They can include invoices in January that aren't due until February, but that company or client already paid you in January. So this is the cash in, not the income or revenue that was generated in January. It then goes through all of the expenses for that time period. And then at the very bottom is the cash outlay and the end of the month. So you'll see that the expenses for January was this 4931 number, and therefore at the end of the month, they have $20,069. That number is then carried up to beginning of month cash for February, and then the same formula is carried out. So in February, they made $7,500. There's their cash outlay for February. Here's all of the cash out in February, and then all of the a total of their cash out, and then how much cash they had at the end of February. If you go through now to an estimated month, so let's start with April. They started April with $27,510. They are estimating that April will make them around $10,000. So they're estimating that they're going to have $37,000 in cash in April. Here's all the cash out that they're anticipating for April, a total of that cash out, and how much cash they anticipate to have at the end of April. That continues all the way down through December, so that you'll see end of the year, this company is projecting that it'll have $71,542. So again, I really want to emphasize that this is cash in, cash out. It is not income or revenue. Some of these months will include previous year. Some of these months will include the next month. And then in December, what they have invoiced for in December, their cash might actually come in January of the following year. So this is not how the company did revenue and expense-wise for the year. This is the cash that they're bringing. And the reason that this becomes so vital and crucial during challenging times is because it helps you to understand, do I have enough cash to make it to the end of the year? And we'll talk a little bit about projections that you can also make for end of the year projections, because it's these two last financial statements that help you to plan and decide in April, am I way behind on what my predictions are? Because you'll have started some predictions for January, February, and March. Am I way behind, and therefore do I need to make a change now? Am I way ahead and I have some surplus that I can put away and put in a fund in case things do get crazy at the end of the year? And are we going to be okay by the end of the year? Because if you can start making changes sooner in the year, and changes can mean that you're cutting costs, changes can mean this product isn't really selling, but this one is selling a lot more during this time period, so let's push our marketing a lot more towards this product or this service. So you are actually able to make strategic decisions versus constantly having to be reactionary to what's happening. So again, just to summarize, that a cash flow statement is an actual representation of transactions that have already taken place, whereas a projection looks into the future to help you predict future cash flow will look like. Before we move on to the next, Katie, do we have any questions that we want to go over?
No new questions.
Okay. So next we're going to talk about end of the year predictions. And this is when the nerd in me comes out the most. End of the year projections is what I love most for nonprofits and businesses, because it's really helping you to determine best and worst case scenarios. So we'll talk through a little bit about what an end of the year projection is, how to read and create one, and then how to use end of the year projections for your business or nonprofit. So a budget is a detailed projection of what a business thinks will happen in the next year. And again, I've already said this before, but going into this webinar, we're assuming that businesses and nonprofits have a budget that they're kind of basing their business on. That end of the year projection is an update to the budget. A projection allows a business to pivot and make changes on the budget based on what is happening. A projection helps you to assess additional revenue and support needed, and allows you to reallocate money wherever you feel it's needed. Most times you want to start an end of the year projection with at least the first quarter done. I personally like to have 2 quarters already completed, because if you have the first 6 months of the year already done, helping to really estimate and calculate out the next 6 months of the year just becomes so much more easy. Most business owners and nonprofit leaders feel that the result is much less important than the process in creating end of the year projections, because it really is a strategic plan that allows you to be in control and make really strategic decisions, again, instead of constantly having to be reactionary. So how to read and create end of the year projections. First, it starts with your actual revenue for the year. Then I like to create what I call a conservative and an aggressive estimate versus your budgeted goals for the year. A conservative estimate is what we also call our worst case scenario, making the least amount of money, spending the most amount of money, and an aggressive is what I like to call the best case scenario. So this is where we're making the most amount of money but spending the least. And finally, you reallocate your resources where needed. So how do people use end of the year projections? They help you to pivot when it's necessary. During difficult times in a business or nonprofit, it helps you to see how the year can plan out for best and worst case scenarios. And it allows you to make important decisions regarding your business or nonprofit before it's too late. So let's take a look at one together. This gets a little bit complicated, so I am going to go a little bit slower on this slide. If you do have questions along the way, please be sure to let us know. But let's get started together. So this column is your actual. So for this company or nonprofit, this is how they did January, February, and March. So this is actual for 2020 all through March. This conservative column is their worst case scenario. This aggressive column is their best case scenario, and this final column is their budget. This column right here is the variance based on their budget and their worst case scenario. And the other great thing about doing projections is you can actually pop in an explanation as to why there is a variance. And this is something that you can share with boards, shareholders, investors, members of your team. So this helps you to explain to people why there's a variance if there is such a shortfall between your worst case scenario and your projection. So through March of 2020, again, this is an update to the budget. So this is how they did on an accrual basis. This company or nonprofit's total income was $31,000. Their expenses, January, February, and March, is this $9,016. So their net income through March is this $22,408. They then created conservative and aggressive estimates. These numbers are not how this company now feels it's going to do April through the rest of the year. These numbers are actually how the company feels it's going to do throughout January through December of that year. So it is looking at what they have already done and including that number in their conservative and aggressive because it's going against the variance of their budget. So conservatively speaking, this company thinks it'll be able to do $119,000 versus their budgeted goal for the year, which is $132,500. Best case scenario, they think they're going to do $139,000 versus their budget of $132,500. So their variance, their worst case scenario variance is this $13,500. For their total expenses, conservatively, this company feels that it's going to go a little bit over budget, which means, again, worst case scenario. So now this is them spending the most. So $49,750 versus their projected goal of $48,250. Their best case scenario is way underspending, and then their variance for their worst case scenario is this $1,500. So worst case scenario, they think they're going to spend $1,500 more than what their budget was. Their net income for January through March is this $22,408. Their worst case scenario is that they feel they're going to make $69,250 versus their anticipated goal of $84,250. So worst case scenario, they think they're going to come in $15,000 under their projected budget. Their best case scenario, and this is based on doing a little bit better in their income and doing better in their expenses, is $103,250. So you can see that there's a big swing between their conservative and aggressive. As the months continue, because now this is something they're going to be doing month to month, those numbers should be getting closer and closer together. And by the time you hit November, those numbers should be very, very, very close, unless the last month of the year you have something really, your numbers really skyrocket. So if you're a company that does a lot during the holiday season, December could be all over the place. If you're a nonprofit that hosts an event or does a huge campaign the last month of the year. But typically speaking, the closer you get to the end of the year, those numbers come closer and closer. So one thing this company can do is they can now say, okay, our budget for the year was this 84,250. Our worst case scenario is 69,250. How do we feel about that? Worst case scenario, are we still feeling comfortable? Do we still think we can stay on track? Do we have to cut any expenses? Do we need to pivot? And they're having that conversation in April versus having that conversation in November and December when things might already be too late. You've already spent your salaries. You've already spent your cost of goods sold. You've already spent a lot of your money at that time, and it's really hard to pivot. And now you're having this reaction versus really strategically thinking through the process. That's a little bit on end of the year projections. Any questions?
No questions at this time.
Okay. So moving on, we do want to let you know that the 3 templates that we went over today, both your profit and loss, your cash flow template, and the end of the year projection template, we are going to be emailing those out to you. So please be sure to follow up with us, email us any questions. I'll leave the dummy numbers in there as well as the formula in there, the formulas in there. So you can just plug away your numbers. I will say that a lot, and we'll talk about this in the next slide, a lot of the accounting software that you use, it allows you to do this for you. But certainly something that you can do on spreadsheets, and especially end of the year projections. Those are all done on a spreadsheet and should be done by the business owner, nonprofit leader, bookkeeper, or CFO that you have working in your company. Before this webinar started, I did reach out to participants and ask them if they did have specific questions that they wanted us to go over. I had a SCORE mentor reach out and ask the following 3 questions. If you guys have questions relating to your company or nonprofit personally that you wanted to discuss, again, I just want to say feel free to reach out one-to-one. We're happy to have those conversations with you. So the first question is, what information do banks require to get a loan to start a business? Now, to start a business is a little bit different than if you're an established business and you have an investor with you that and you already have some data and history and financial statements available. But if you're just starting a business, banks will want to review your credit score and your credit history. They're going to want to see a business plan, and they're going to want to start reviewing some borrowing options with you. At Capital CFO, we really have great banking partners that we can get you in touch with. So if this does relate to you, please be sure to get in touch with us. We can share with you some of the partners that we have. What information can I use to help understand and manage my business? So obviously at Capital CFO, financial statements are our entire business. So your financial statements are your tools. They help you to see your budget. They help you to see what's happened in the past. They help you to pivot when you need to, but they also help you to forecast and determine strategically what you need to be doing instead of constantly having to react and sitting down and saying, okay, we need to pull $30,000 now in order to cover XYZ expense. You can see those expenses coming down the pipeline. And we're obviously here to help. So what we do as a company is we outsource bookkeepers and chief financial officers to help companies and nonprofits with their financial statements. So if that's something that you do need help interpreting, just let us know. What's the easiest way to generate and organize my financial information as well as help my CPA? This is probably one of the questions that we get most from our clients as well. We are not a taxing firm, so we don't help people with taxes, and we're not tax consultants. But what we do is we partner with tax consultants and CPAs. If you don't already have one, we have some wonderful partners that we can get you in touch with. But what CPAs really want and what tax professionals really want is clean financial statements. They want to hear from you quarterly versus end of the year, and they certainly don't want you to hand over kind of your box of receipts and tell them to do the bookkeeping for you. It's also not very cost effective to have you as a business owner or nonprofit leader do that. So if you do need help kind of getting your financial statements organized, we're here to help. Getting an accounting software can be really helpful for businesses. And there are some out there that are really, really inexpensive, and even a couple that are free. What an accounting software system does for you is it does a lot of that calculating and formulas just in the background. It also allows you to generate invoices, and you can kind of set those up automatically. You can set up automatic expenses as well. So it does a lot of those features for you in the background. I have seen companies run their businesses solely on spreadsheets, and they've done it very successfully. And as long as they have bookkeepers and CFOs that are kind of keeping up to date with that and being really, really specific with their teams on the information that they need, it certainly can be done. But an accounting software tool and system just makes that process a lot easier. And then you can pull a lot of these financial statements right from the accounting software. You as a business owner or nonprofit leader still have to have your bookkeeper or CFO or you yourself manage the accounting software. So it's not just that you buy it and it's all completely done for you, but it does do a lot of that background stuff that we've talked about. Any other questions before we wrap up today's webinar?
We did have at least one additional question, and that is, will you address the impact of PPP or Paycheck Protection Program, I think, loans on budgeting, since there is an unknown on the forgiveness factor?
Yes.
So I'll repeat that. Oh, you got it? Okay.
Yep, I got it. So I would say the first thing that you need to do is get in touch with your lender and start talking about what guidelines you need in order for it to be forgiven. Work very clearly and hand in hand with your bookkeeper and your CFO and your accountant. And some people are even utilizing a lawyer to kind of help them figure this out. If you are unsure if it's going to be forgiven, you're going to want to set it up as a liability. So set it up as a loan, as you would as a loan, the interest rate that they're kind of talking about. But if you know that it's going to be forgiven, then you can set it up so that it's not a liability. But most people at this time are banking on the fact that it's going to be forgiven. So most of my clients, I can't think of any right now, actually, that we haven't set it up as a liability. So once it's forgiven, that can easily be moved over. But if it's not forgiven, then at least it's sitting in there in your liability account. Any other questions?
We do have another question. What accounting software do you recommend for a simple business?
So my go-to would probably be QuickBooks Online. As a business owner, you can get it from anywhere that you have internet, so you can take it with you at all times. You don't constantly have to be updating it. It's doing that for you. You pay month to month based on what your needs are. So if you're a company that doesn't need to run payroll through it, for example, it's really very, very cost effective. So QuickBooks Online is kind of my go-to.
That is all the questions we have right now. We can give everyone another moment if they want to throw a question in the chat box.
Sounds good. And then here is all of my contact information. Again, my name is Sabrina Hauser, and that's my email and direct line where you can call us. The two women that are on the line with me today are two of our directors at Capital CFO, so I want to thank them for their time as well, Katie and Liz. If you guys do have specific questions that you have regarding today, please don't hesitate to reach out. If you have anything specific, again, that pertains just to you and your company, we will absolutely set up a free consultation with you and help you to navigate during these challenging times. It's crucial that we all work through this together, especially if you're a small business owner or nonprofit, and obviously nonprofit they own my heart. So I understand that we really are the backbone to this economy and to our communities. So anything that we can do to help, don't hesitate to let us know.
Great. Sabrina, we do have a couple more questions that came in.
Okay.
So the first is, are there tutorials that are provided for QuickBooks that you suggest?
Yeah, QuickBooks actually has a lot of free resources available that allow small business owners and nonprofit leaders to actually learn the system themselves. So once you're a part of QuickBooks, you can navigate it that way. They also have a lot of tools and resources that you can use through their help desk. And then I've also noticed that there's like QuickBooks boot camps that are out there that are free to use to help you get QuickBooks certifications.
All right, the next question is, how often should a business forecast or reforecast in this changing time? Is monthly enough?
Yeah, monthly would be my go-to without a doubt. And like I said, I normally start 6 months in, but in these challenging times, I would probably start after the first quarter. But yeah, I would say you should be forecasting monthly and pivoting as needed. But even having weekly or twice a month meetings with your bookkeeper and CFO to see how things are going, and any updates that you need, or if something major does come down the pike, should be enough. It's certainly not something that you want to do daily, because you can definitely drive yourself a little bit crazy looking at the numbers. And that's coming from a numbers nerd. So.
All right, that's all the questions we have right now.
I want to thank everybody for joining us this morning. I hope that this was helpful. We will be sending out not only the recording, but the templates. And please join us next Tuesday for Nonprofit Survival during these challenging times. That webinar is starting at 10:30 in the morning, also via Zoom, and will be handled by our 2 directors. If you want to sign up for that, please just email me directly and we'll get you that Zoom link. Any other questions, be sure to let us know, and thank you all for your time this morning.